The concept of insurance is actually quite simple, but it's often made complicated because insurance policies contain a lot of jargon. In this video, I'll try to decode the insurance industry. Insurance companies provide insurance to thousands of people who face personal property and liability risks. Each person has different risk management needs too, so companies offer different types of policies to give them some choice. Now, a policy is a contract which states the circumstances that a policyholder, which could be you, is entitled to some sort of compensation. For each circumstance that you can receive compensation, this is called the cover. For any circumstances where compensation is not provided, these are called the exclusions. For example, if you take out basic travel insurance, the policy might provide cover if you get injured whilst you're overseas. However, an exclusion might be that if you lose your luggage, you might have to pay for this yourself. So, to fulfill an insurance contract, the policyholder must pay a fee, usually annual, to the insurance company. This is called the premium. The amount of premium paid depends on how risky the person is in the eyes of the insurance company. For example, if the policyholder is a P-plate driver after car insurance, they will likely pay a much higher premium than an experienced driver because statistically they are more likely to have a car accident. Now, insurance companies have tried to create ways for people to reduce their premiums if they feel it's too high by offering a policy feature called an excess. And to illustrate how it works, let's say that you've taken out comprehensive car insurance with an excess of $500. What this means is that if you make a claim for damages on your car worth $500 or less, you have to pay for this. And if the damages exceed $500, then the insurance company will only provide compensation for damages above this amount. For agreeing to hold some of the risk, the company will reward you with a lower than standard premium. Okay, so now let's look at compensation. If the time comes where you need to make a claim, and the insurance company approves this compensation can either be paid just once, called a lump sum payment, or over many time periods, called installments. The majority of policies will pay out a lump sum, but an example of one that pays an installment is income protection insurance. It's worth noting that a person who is entitled to compensation from an insurance policy is called the beneficiary. So, in the case of some policies like life insurance, the policyholder might name several beneficiaries so that they're looked after if the policyholder passes away. Finally, if you're taking out insurance to manage a type of property risk, you might have to think about whether you want to insure the property for the agreed value or market value. Let's say you've bought a car for $6,000. Under an agreed value policy, you can arrange that your car is insured for the same amount. So if your car gets written off, you can receive up to $6,000. Under a market value policy, you leave the amount of insurance you can receive open to what the market value of the car is at the time of the incident. So if after 2 years the car is now worth $4,000 due to depreciation, you would only receive up to $4,000 if the car was written off. And that's a summary of how insurance works. There can be lots of confusing terminology that might throw you off, but once you understand the insurance language, reading through policy documents becomes a lot easier.